Well, traders, are we in the eye of the storm or the calm of the storm? I want to ask Jim Welsh from Macro Tides, and that's why I'm going to bring him in to talk about. Hey, look, Jim, things have quieted it down a little bit this week. We've seen this, kind of back and forth in the markets, and there's still a lot of headlines regarding tariffs. It looks like we might be making headway with the EU. We had Prime Minister Meloni from Italy. She was meeting with Trump yesterday. There's some indications that China and the U.S. might start talking, but is this just noise? Is just this a calm? Are we about ready to? Is the proverbial poop about ready to hit the fan? I mean, what do you think is going on right now from your point of
Yeah.
view on how you see things?
Well, the whole trade negotiation is a process. And what we've learned is it's not a process with one or two countries. Uh, they're working on having deals with every trading partner we have. And so we're going to get piecemeal information in coming weeks where, okay, we got to deal with Estonia. We're wonderful. We're making progress. And I just think that's just the way it's going to go. And there are going to be announcements where they can say, yeah, we met with Japan, but I don't think them coming over for the initial conversation, Blake, is going to be wrapped up in 2 days, and now we got a trade deal. It's very unlikely. I think what we're seeing is one-to-one conversations laying out the groundwork in terms of what the U.S. wants, what Japan is willing or unwilling, and that's going to be repeated with every single major trading partner. So the market is going to continue to be held hostage, I think, to what's going on. There is no huge reduction in uncertainty, and I think that's the word that has been or best described what we're dealing with. Uncertainty, and then there's a flash piece of news. Everybody has a knee-jerk reaction, and then we're waiting for the next body blow.
So, I mean, with you have, assets like gold that are obviously going to the moon at this point in time. And I mean, I know you're going to bring technicals and
Yeah.
give us a base case on how you feel about the markets. But should we be worried? Do you think this? I guess the point. Actually, let me just get directly to the question.
Yeah.
The market sold off and we're now consolidating. It's not like we've had this sharp V-shaped recovery. The markets have sold off and they are just holding lower. That technically is like more of a bearish sign to me than anything. Despite any of the news headlines, and I think we all understand that the Trump administration is going to make headway more than likely with with most
Most. Yeah.
countries. But is this just a setup to where we're setting ourselves up for failure in the markets because the markets are like the damage has been done, or do you think that there's really there's a case to be made to rally to all-time highs? And I'm just going to talk about equities in general, so let's
Right.
just talk about the
Yeah.
S&P, not so much individual markets like the DAX or a CAC 40 or Nikkei or whatever, but just in markets in general. Do you think there's a base case that we could actually hit new highs at this point?
In my view, right now, no, because we have, again, so much uncertainty. And, point that we've discussed is that where the Fed is at is, wait a second, we know we're going to get inflation. And what Powell said in a speech the other day was, okay, the tariffs are bigger than we expected. The boost to inflation is going to be bigger. There's a chance it could impact inflation expectations. And the Fed really believes, whether they're correct or not, I'm skeptical. The idea that, well, people think there's inflation coming, that'll add to inflation because they'll buy more now because prices are going to be up more later. Well, that's true in a tariff world where a certain date, prices are going to change. But overall, people's spending habits are really based on their income levels. And what we know is over the last 18 months, those in the bottom 50% of wage earners have been under the gun. So I think again we're stuck, and the Fed is stuck, and it's going to take something to move them off the dial. Those two things in the short term are a dislocation in the financial markets, where markets start to seize up, Well, when that's going on, the stock market's going down, and usually by a lot, or the unemployment rate unexpectedly ticks higher. And I don't think that's likely either in the very near term. So the Fed is on hold, sitting on the sidelines. And I think that's one of the shoes that would need to drop, that people would have confidence that, fine, yeah, things are bad, but the Fed is going to come to the rescue. And we don't have that. And the tariff stuff is going to drag on for we don't know how long. So it's difficult for me until you really address those other issues. Why would anybody buy and keep buying, given what the overhang is for the equity market? Plus, the other
That
idea
makes
is,
sense, and
yeah,
we've heard it from a lot of Fed governors, including Powell, that
yeah,
they're really just this week in Chicago that they're pretty content keeping rates where they're at right now.
yep.
And so you're
Waller
not
is
getting
the
that.
only guy who's I would say is a little bit not in that camp. He's like, we're going to be cutting rates one way or the other. Okay, Chris, and he's well respected. But I
And
think for
this
the
is Chris
majority of
who?
Chris Waller,
Waller. Yeah.
yeah, he's part of the board of governors, so
Right.
he's not a president. So
Well, that's because he's jockeying for Powell's spot.
well, you know what? Who knows what his intentions are? All
Yeah.
right.
All right. All right. All
So,
right. Well,
but
without
I think
spec.
you're right, though, Blake, is that the majority of people, based on their speeches that are on the FOMC, they feel I got to sit on my hands. So the next meeting, I think, is what, in a couple weeks, early May. Are we going to see anything that would provide them the certainty that they need to act? Not unless, markets start to seize up, and that's possible.
God, did you see the unemployment claims this week? I mean, the rise in it. I'm joking that they're still stuck.
Yeah, they're still hanging around, what, 215?
215, two, so through
And
13,
here's,
whatever it was. Hey,
yeah,
look,
yeah,
first of all, I just want to make sure I've mentioned this to people. Today is Good Friday, and instead of observing Good Friday, Jim is here observing my face, which is not necessarily a pleasant thing. So,
that's a wonderful phrase.
if you guys appreciate that Jim's here on a holiday, make sure you give him a thumbs up and subscribe to the channel. Tell him down below in the comments. Thank you very much, Jim, because people should be appreciative that you're here on your holiday meeting with them. So, without
Yeah,
further ado, let's get into some of these. Let's get into some of these charts that you brought,
yeah,
and
yeah.
actually the first one I saw this circulating around social media this week. Tell us why you brought this.
Well, I think it actually explains a lot of what's going on, in terms of I hold the cards. Well, we do to some extent, given the amount of stuff we buy from China, and they are export-driven economy, especially now. And at the same time, President Xi saying, huh, cards are made here. And it underscores things like rare metals, pharmaceuticals that we are highly dependent on. So, on one hand, Trump is right. We shouldn't be so dependent on one country for pharmaceuticals. We need to make that exposure less than what it has been. But as it stands right now, the cards are made in China. So are the pharmaceuticals, the rare earths, and all the rest. So this is the impasse. Both countries hold leverage in these negotiations. And I think what China has shown is they're not afraid to flex their muscles a little bit. They're just not going to roll over. It's
Right.
not, I think, in their DNA to do that. And so, again, some of the issues that could get raised, not just with China, but Canada, Mexico, is supply chain disruptions. Where that really becomes an issue 30 days from now or whatever, if these trade talks drag on that long.
Yeah.
So that raises the issue of, gee, things could slow down and slow down meaningful enough that people begin to worry about a recession. That's another reason why I think, we're not ready to go to new all-time highs, given everything that's out in front of people.
All right, makes sense. Jim, the next chart you brought up is pre-tariff buying. You mentioned this or
Yeah.
alluded to this in our before we started showing these slides about front loading some purchases. Why did you bring up this chart? Why is it important to us?
Well, it shows that the prospect of tariffs changed people's behavior. Obviously, companies also went out and bought stuff in December, in January, and in February. And now consumers are like, I'm going to the store and buying stuff. All right. And we saw a big pickup in auto sales because there's going to be subject to potentially, you know, larger increases in the price. So again, the concept here is stuff I would have bought 3, 6 months from now. The tariff prospect makes me think, you know what? I'm buying it now. I'm buying it now. Well, what does that mean? 3 to 6 months from now, when I was initially planning to buy the car or whatever it was, well, I've already done that. So in the short term, the economy is going to look better than maybe it really is as people buy stuff and companies make stuff in order to satisfy that. And obviously, the next trade number is going to be, probably a blowout, and that's already happened the last 2, 3 months. So it's just more evidence of this phenomena. From the Fed's perspective, they're going to keep it. Well, the economy seems to be okay, you know.
Yeah.
So for them, it's more justification to we can afford to wait, and so there's distortions being created, not just on the price level, but behavior wise. They're going to have implications for the economy, both right here, right now, but as we go forward the next 3 to 6 months.
Okay, well, and it's going to be really interesting to watch these numbers over the next few months. I'm interested to see not only what the trade numbers look like, but also our consumer retail sales numbers for the next couple of months as well, and if they really do taper off dramatically. I think that's
Yeah.
and how dramatically is probably going to be where the market starts gauging
Well,
things.
just think about it. Consumer sentiment reports that have come out, Blake,
Yeah,
show that
horrible.
consumer sentiment has just nosedived.
Yeah.
But you look at this chart and you say, if you're just looking at this chart, you would think, wow, we didn't know anything about tariffs or anything. Just blindly looking at that, you would say, whoa, consumers went on a binge in the month of March. It's the best number, I think, going back maybe 3 years or something. So I pointed in isolation, you would look at this and come to a completely different conclusion than what
Sure.
we're talking about. And you're right. It'll be interesting to see how quickly the future retail sales match the decline in consumer sentiment, which has really dropped a lot.
Well, this next snippet you brought is interesting because we just heard, and before we talk about this, just about an hour ago, senior White House official Hassett says, Trump and his team will continue to study the matter about Powell, and when asked about the Fed chair, says they're studying whether firing Fed Powell is an option. Now, do you think this is just the scare tactics for Powell? Do you think there's some validity to this? I've had a lot of pushback from people in my community saying, Blake, if they could do it, they would have already done it. If Trump could do it, he would have done it a long time ago. So maybe this is just a lot of scare tactics to try to get Powell and the FOMC to lower rates. But what do you think? I don't know. That's why I'm going to ask
I
you.
think, given the nature of Donald Trump, for him, it's serious. I mean, here's a guy who's not helping him out, and he recognizes that the economy is going to weaken because of everything that's going on, and he would like the Federal Reserve to help. At the same time, there's other people in the White House that are counseling him. Now's not the time, Donald. Look at what's going on in the 10-year. Remember, a month or so ago, Treasury Secretary Besson said, yeah, President Trump and I are focused on the 10-year Treasury yield. Their expectation and hope was that the 10-year Treasury yield would come down so that mortgage rates would come down and that would be beneficial for the economy. That hasn't happened, which I think is more Trump saying, hey, if he would cut rates, we would have the 10-year down. So I think there's real discussions going on about this, Blake, and whether or not it would be prudent to do this, irrespective of the legal stuff. Now, we also have to remember, Powell has been asked about this repeatedly, going back, I think, probably to Trump's first term. And he's been, hey, I've got a job to do, and I can't remember if it's April or May of next year, something out there, and I intend to stay. So I
Yeah.
don't think Powell will cave into if President Trump says, I'm requesting that you resign. I don't think Powell will do it.
Even though he
Uh,
said he would leave if I asked him to, or something like that. I think what is
well, of course, Trump is, again, we
it's
have to understand
optics. It's optics.
yeah, we have to understand who we're dealing with. I think moving on Powell right now would be extraordinarily bad.
Oh God,
You
yeah.
know,
I mean, the dollar would dump, the stock
you know,
market
it's,
would dump, bonds would
it's
dump. I
like the
mean, we would
line
see
from Ghostbusters. Well, what if the streams cross? It would be extraordinary bad.
it.
Well, I just think at this point in time, that would be extraordinarily bad. I mean,
Yeah.
the
Uh,
charts of the 10-year, think about the weakness we've seen in the equity market. Historically, there would have been a much larger knee-jerk reaction to people buying treasury bonds. Didn't happen. Now, I think, again, we have to remember, and we talked about this last week, thing called the basis trades, hedge funds, long treasury bonds, short the futures. It's called a basis trade because you're talking about extraordinarily thin margins, the spread between those two instruments. And so they leverage it 100 to 1. And there's been some firms that really got blown up in the last 2 weeks as the basis trade widened out and they were forced to sell their treasury bonds. So we've got that other component that it's almost impossible to say, well, is that 50% of the reason why treasuries didn't behave as they normally would? Or is it 70%? Or was it only 10%? I have no idea. I think it definitely played a role in keeping the reaction that the bond market normally would have very muted.
yeah. Okay. All right. Well, the before we get into the technical charts, last snippet you brought here is recession odds.
Yeah.
So if economists are expecting a recession, we should expect there's no recession. Correct?
Well, in 2022, and you and I had numerous, conversations about this, especially in the summer of 2022, we had had two negative GDP reports, first quarter and second quarter of 2022, which is the traditional definition of a recession. And so all the economy, oh, we're in a recession. But in our conversations, I was pointing out if you looked at things like job growth, which was still really pretty strong,
Yeah.
consumer spending was still quite strong, that we were not in a recession. It was due to the way they calculate GDP, fluctuations in trade, which subtracts from GDP, and then inventories in the second quarter. So there were good reasons to push back. For me, Blake, right now, I wouldn't just dismiss it because they were wrong in 2022 to say, okay, they're wrong now. Because the longer this trade stuff goes on, I think it's going to have real economic impact.
Sure.
So, I just think that, again, think about it. The bottom 50% have been under the gun. If prices go up, they're going to be even in a bigger hurt. And the top 10% are 20 or 50% of consumer spending. Well, they got a lot of money in the stock market.
Yeah.
And guess what? They just took a hit. So, not that they're going to stop spending. All they have to do is pull back a little bit. And since they represent 50% of consumer spending, that means a lot. So, if
Sure.
the equity market continues to be under pressure and does, in fact, go to lower lows, that just raises the odds that the upper 10% are going to cut back more.
All right. Well, let's figure out what it means for the markets. And now you're talking my mumbo jumbo. Here's the dollar. You brought a couple of charts for the dollar. So what are we looking at here,
Yeah.
Jim?
Well, this is just kind of the near term from the high above 110 in January. I think we're nearing the end of that decline. And you and I talked in January. The expectation I had was I think we're going below 100. You could even get down to 95. And so now we can look at what actually has transpired.
Sure.
Getting to 95 may not happen, but we're obviously already gotten under 100. And the pattern to me looks like you could get one more decline below 99.01, and that would increase the odds that the dollar at least has reached a temporary bottom. And I think potentially we will then see a subsequent retracement. that could get it back to 104 or some number like that, and potentially even higher. Well, there's a lot up in the air, but I just think
Yeah,
sentiment has shifted. Remember, coming into this year, people were really wildly bullish. Oh, tariffs are going to drive the dollar higher.
sure.
And my point was, at some point in time, people are going to shift from that to, well, yeah, but it's going to hurt the economy. And so sentiment now is really, really negative towards the dollar. Again, in the last 2 weeks, I'm sure you've heard it too. Well,
Yeah.
the reserve currency of the dollar could be at risk here. I think that's
Yeah.
baloney. Okay. Um, so just technically, the sentiment, the price pattern all suggests that the dollar is probably nearing a trading low, and then we'll take it from there.
All right. Well, this is your long-term chart of the dollar, Jim. So explain to us.
Yeah, well, the next thing we're going to talk about is a short-term picture of gold.
Yeah.
But I mentioned this last week, and this is why I brought this chart. The top is the dollar, the bottom panel is the gold, and that basically, as the dollar was topping out in September and October of 2022, gold was bottoming. And the pattern that I was working with in terms of the dollar was that you had a 14, 15 point decline from 114 and change. Then you had an A, B, C up to the 110 and change for a B wave, and that we were going to see a C wave that took the dollar under 100. So that has transpired. So we're at a point where, from a longer term picture, you can say, wow, the dollar is not just a short term low, but a more intermediate term low. So gold bottomed as the dollar was topping at 16.16, and we've seen what I think is starting to look like a blow off top in gold at a time when I think the odds are that the dollar is nearing a decent trading low, and it could rally 4, 5% just as a retracement of the recent decline. And I think that would put downward pressure on gold. I, I've been bearish the dollar, and I thought gold was topping at 3,100, 3,150, and obviously wrong. And I think the weakness in the dollar, along with everything else we're seeing in the world, has really brought money as a magnet to gold. And when so many other things aren't working, Blake, you know what happens? Oh, that's working. I want to get on that bus. And I
Yeah.
think that's part of what we're seeing in gold. But from a long multi-year perspective, all I'm trying to show is, wait a second, folks. In the fall of 2022, the dollar top, gold bottom, and now for me at least, I have reasonable expectations that the dollar is going to make a solid trading low. And I think if that proves correct, gold is going to have a retracement. And I think it's going below 3,000. I think there's a real chance that we could see 2,600.
All right.
So I'm going
Well,
to go make a crazy comment. Gold is
well,
going to
no, no,
see,
no. And I remember in the past, I was like, I couldn't see the dollar dropping below 100, and you've been right. So let's see how I know you just said you think gold's in a blow off top. It's in a topping. It's not in a
yeah.
topping pattern. It's just in a straight up move. But
Well,
I
that's what
mean,
a blow off is,
yeah,
Blake. The last 2 weeks,
yeah,
it's
it is
like we
blowing
don't,
off, but we haven't seen it capitulate either, right?
no, I mean, you got to respect, one of the things I have in there about limitations of RSI. RSI is a great indicator. MACD, great indicator. But the mathematics that underpin those two indicators, if you get in a strong trend over weeks of time, the RSI will give you bad signals. I mean, and I've referenced it when we got to 3150 or so. I'm like,
Yep.
hey, you got an RSI divergence, and if it gets below 3,062, and it did all that. And now look at where we're at. So it's important, this is one of the lessons I've learned. You get run over a couple of times, you say, wait a second here. Same thing works in big, strong declines. The RSI will diverge and it's still going down. So this is the flip side. This is why, as you and I have talked over the last few years, it's important, I think, to use moving averages because that is following the price trend. And so
Yeah.
I'm a fan of the 5 and 13 exponential moving averages. The red is the 5, the green is the 13. And you can see over time, a lot of markets, not just gold, uh, the 5 stays above the 13, and you get into a trending market, it's beautiful. Even when the RSI starts to diverge, until you see things roll over. So it rolled over for 2 days, I think, as we saw it tag that blue trend line, and then it reversed. So to me, we need like a round of golf. I don't golf, but you have a bunch of clubs in your bag, and if we're a technician, we need a bunch of clubs in our bag. RSI is a great indicator, but the 5 and 13 exponential moving averages are also a great help in terms of identifying trends. And so
Sure.
right now, I think it's a blow off, and what this is saying is we have no real solid evidence that gold has made a top yet.
Okay. All right. Well, Jim, the next chart you brought is TLT, and this is a bit of a mess. I guess I can put it
Yeah.
that way. It's a bit of a mess. How do you see it? Do you think the fixed income is going to continue to sell off here, or are we done?
I don't know. I mean, honestly, the one thing I do know from that 101 and change high, you can kind of see 1, 2, 3, 4, 5 to the low at 84, 89. And that's when I thought, okay, we're going to see a retracement rally. And we got a nice pop from 84 and change to over 92. All right. I was expecting a pullback and then another push. And that pullback did an irregular B where you had three waves down, a pop up to 94.09, and then this drop down to 85 even. So the bullish pattern, Blake, is all right, we're retracing the decline from 101 to 84. We've had an A wave, a B wave, and we're going to get a C wave that takes us above 94.09. But ultimately, that five down from 101.64 to me says that once the retracement rally is over, TLT is going below 84. So is it going to do it in the very short term? It could be. That you had an ABC up to 94. This decline from 94 to 85 is wave one of the next declining wave. And we've got kind of a weak little bounce. So that blue line is at 89.50. So, to me, it's kind of like it needs to get above that uh, to really increase the odds that a rally above 94.09. So this is one of those things, I've said before, Elliott Wave is a great another tool in the golf bag, but there are times when you can come up with two choices and even three that are almost in balance in terms of the probability being one or the other. For me, this is one of those times that there's fundamental reasons why we could see treasury yields go up more. And at the same time, there's fundamental reasons, gee, the economy is really slowing, that we could see treasury bonds rally.
Yeah.
So
So
right here,
when
for
you're
me, it's
faced
a
with
no man's land.
when you're faced with poor risk reward and and your probabilities are about even, there's no problem with standing aside and
So
letting the
wait until
market
it gets clear. You
show his
know,
hands. Yeah.
yes,
Okay.
yeah, and
Well,
that's sometimes, as I said, Elliott Wave can be helpful in that you've got two choices; they're diametrically opposed. Well, that's information that's useful as far as what I think, as you just said, you just don't do anything for a while until it
sure.
gets clear.
All right. Well, last chart, everybody wants to know, are stocks going to resume their downtrend, or are we going to finally get a recovery rally? So, what are your thoughts here, Jim?
I think we're going to a lower low than 48.35. One of the dynamics that I think is underappreciated when the market's in good shape, the economy's in good shape, certainty is like, okay, things are okay. Selling pressure and the reasons to sell are almost non-existent. And for, a couple of years, that's exactly what we saw.
Yeah.
In February, I was talking about we do now have a reason to sell with the tariffs coming. The advanced decline line was diverging. I was looking for a 7 to 10% decline because finally we were going to have a reason to sell. Well, look at, back to our earlier conversation. Going to new highs. All right. What are the reasons to buy right here, right now? I don't have any.
Crickets.
I mean, legitimate reasons.
Right.
I can say, well, I think Trump is going to work this all out, and China at some point is going to cave, and then the Fed's going to, maybe all that's going to happen. All right. But I don't know that right now. What I
Yeah.
do know is like,
Maybe. Right. It's a maybe.
it's a big maybe. What we do know is that there are more reasons, I think, to be a seller, given where we are in the process of the trade negotiation, where the Fed is in terms of monetary policy. The economic data is likely to be okay for a little while because we're always getting data that's 30 days old. But as we get out into June, I don't think the data is going to be as happy or look as resilient as it has been. And so to me, there's more reasons to be a seller, and we're going to see inflation tick up. And as we talked a month or two ago, I think I showed the CPI data, and the takeaway values for May, June, and July from last year are really low, like 0.1% about for those 3 months. Well, the CPI could easily be coming in 0.2, zero point 0.3 when the tariffs start to hit. And all of a sudden, the CPI is going back above 3. They might even make a run at 4 over the next 6 months. And so is the Fed going to tighten or raise rates because of that? Not in my mind. I think there's zero chance the Fed will raise rates. But what it will do is keep them waiting for the other side of the mandate, that is the unemployment rate, to go up, because then they can justify acting. And I think that's the hard rock that Powell and company are in. They know inflation is going to go up. They don't know by how much. And at the same time, the economy and unemployment isn't really giving them justification to cut rates. So
Right.
they're kind of on their hands too, waiting. And so when I add it all up,
in a nutshell, just to wrap it up, Jim, I mean, just to wrap up what you're saying, there's no Fed put. So the risks are at this point in time tilted to the downside in equities until we
I
see
wish I
something
had
change.
said that clearly and simply. Thank you, Blake.
Yeah. So, well, it's
No,
Easter
you're right
weekend.
though.
I mean, hey, but speaking of which, Jim, I want to thank you every week. Without, you even when you're on holiday and you're traveling around, you jump out on our calls when you can. If you guys all appreciate what Jim does, make sure you give him a thumbs up. Jump down in the comments below, tell him thank you, and wish him a happy Easter. And Jim, what's the best way for
Thank you.
traders to get your latest technical review?
Send an email, Jim Welsh Macro at Gmail. I'll send you the most recent report. Go to macrotides.com. And part of the reason why I can't skip these Fridays, Blake, is that then I wouldn't get to see your face.
Thanks, Jim. Hey, I almost said Merry Christmas.
Not Mary.
Happy Easter to everybody.
Same to you.
If you celebrate, for those of you that don't celebrate, just enjoy a nice long weekend and hope you get a lot of rest. We'll catch you next Friday. Jim, thanks for joining us, and happy Easter to you and your family.
Welcome, Blake. My pleasure.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.